If you were to explain to someone who doesn't, typically know or deal with working capital, how would you explain to them in plain English how a buyer sets the working capital target?
Yeah, so I guess to give an overview of what working capital is, the common example or analogy that everyone uses is it's the gas in the tank of the car, so you can drive it off the lot. You buy a business, and I think most business owners would resonate with the idea that, uh, yeah, cash flow is key, and when you're tight on cash, it's usually a working capital issue. The goal of the working capital peg is to determine exactly how much cash needs to be left in the business. And it's not cash in the sense of money in a checking account. It is cash in the form of accounts receivable, inventory, and accounts payable. Of course, there's other, prepaids, accrueds, things like that, but those are the big buckets. I think the issue that we see is, sellers aren't really looking at the balance sheet in the way that they should be, right? And there's a lot that goes into what is your accounts receivable balance? How much is over 90 days, right? And the buyer is constantly looking for areas that they can deduct, right? So their goal is to remove certain current asset accounts such as aged receivables. If your receivables are over 90 days old, they will say there's a high likelihood that we won't be able to collect those, and therefore we should exclude them. And if we didn't account for that in setting the working capital peg, that ends up being a dollar for dollar deduction. I think the same can be said for inventory, right? We just closed a deal that inventory as an industrial distribution company was a significant portion of working capital. Well, just like any small business, they've been operating for 40 plus years. They've accumulated a lot of inventory over the years because, yeah, you can sit on inventory for a long time very cheaply and sell it for a very high margin if you're willing to hold on to it long enough. The problem is these buyers will say, well, if you haven't sold it in the last 3 years or 5 years, whatever it is, we think it's obsolete. That's not real inventory. And if we said inventory is 5 million and they say, actually, it's 4 million and a million of it's obsolete, that's $1 million deduction that the seller is going to take. And again, that's a true up that happens 90 days post close after money has been wired and the seller no longer has control over the business. So it's real risk. And I think this is an area that advisors constantly overlook, or they can't have a very objective view of it. They don't wanna see the buyer and the seller side, and so they'll get very aggressive with adjustments in one direction and lead to a deal falling apart at the last minute. I mean, we see that all the time.
See, that was good, right? So obviously, you mentioned AR in there. You mentioned inventory. I could mention the customer deposits, vendor deposits. One other thing is like the prepaid expenses, right? Paying insurance up front, but getting the benefits over the next 12 months, right? That's a working capital item, and typically small businesses don't even record that. They just expense the premium
Mm.
when it's paid, right? So, but it's a material working capital item. There's accounts payable. You could talk about accrued bonuses, right? Most companies pay bonuses in December, and when that 100 grand or 200 grand is paid out in Christmas time, that's when they expense it, not like ratably or equally throughout the year. So obviously, a lot of items here. It's very complicated, right? So you can kind of see why this is an issue because just the amount of well, first of all, like the sellers aren't even looking at the balance sheet, right? They're probably at the minimum looking at the P&L and the bank statement,
Right.
right? So balance sheet, they don't know what's going on. It's point in time. So the day you pull the balance sheet is what the balance sheet shows. It doesn't show what has happened the day before, the month before, the year before, right? So clearly, it's a material fact in the transaction, and it's a difficult concept to grasp. And you had to look at both sides, buyer and the seller side, to come up to like you said, an accurate working capital figure, not a figure that benefits one side or the other, right? So, would you say that your recommendation is like someone like a deal advisor, M&A advisor, or an investment banker, be a part of these transactions just because of the working capital issue and like advising on that, right? I mean, that's one of the reasons why you should have an advisor, like a critical reason.
For sure. Yeah. I mean, I think brokers, M&A advisors, they might get a bad rap because, they're expensive, right? But I actually think that when you compare it to the value that we actually add in a deal, I mean, every one of these working capital items, you can assign a real value to, right? The deal we did, accrued bonuses was a $350,000 item. Vendor rebates was a $250,000 item. Inventory, it was over $5 million, but the portion that was open for interpretation was about 1.5 million. The aged receivables were 250K. So when you put all of these buckets that are open for interpretation together, I mean, we're talking about millions of dollars, and it is a dollar for dollar reduction. And the sad part is, it's a little bit different. A private equity firm, when they sell a company, it's transactional. They buy companies, they hold them for 5 to 7 years, they sell companies, and they make a return on their equity investment. With a small business owner, they're selling the company because they want to retire and they want to take the proceeds from the sale and enjoy their retirement. Um, the problem is they're planning for that number that they get at close. What they're not planning for is 90 days after when all of the adjustments take effect and the number is now 20% lower. And they've already, planned for a retirement with a higher number. And I think that's one of the reasons too why it's so hard to, you know, get sellers comfortable with this entire transaction process. It's scary. There's a lot of unknown, and there's a lot of people that I don't think, uh, I don't want to say you can't trust them, but it's just hard to build that trust, right? It's a topic you don't understand with people you don't know, um, unless you have like a lifelong friend who's an M&A advisor. You probably don't know anyone that knows how to do this. And it's one of the most important transactions in your entire life. Not even transaction, it's one of the most important days of your life, right? Up there with the birth of a child, wedding days. It's a real exciting moment and it's very important that you get it right.